Hello fellow compounders, welcome back. Are you trying to plan for your retirement? Would you like to retire with $100,000 in income per year? Well, if you're planning for your financial freedom, or what some people call retirement, you are in the right place. In this video, we'll review the financial plan of Linda and Larry, a couple in their early 50s. They have not been diligent in saving for retirement, and they are playing catch up, just like a football team in the fourth quarter. But they have no debt and they have a decent income. Their original objective was to retire with around $115,000 in retirement income at age 67, or the equivalent of $100,000 in today's dollars. However, after surviving a bad case of COVID-19, they've decided that they would like to retire earlier at the age of 62 to enjoy life while they still can. Can they do it? Well, we'll find out in this video. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you're responsible for your own financial decisions. Linda and Larry are both 53 years old, and they have a daughter that just graduated from college and has left the nest. Linda and Larry are both accountants and work from their home office. They offer accounting and tax preparation services to mom and pop real estate investors. Between the two of them, they have a combined income of $190,000 after or net after tax. Between both of them, they have a combined income of $190,000 per year, net after taxes. Their total expenses last year were $190,000. Basically, they spent all that they earned. However, this year they expect their expenses to be $140,000 per year. The difference is that they don't have to pay for their daughter's college expenses anymore. So they have $50,000 per year to stash away for retirement. Let's look at their balance sheet. The only debt they have is a $200,000 mortgage. They pay $60,000 per year in mortgage payments, excluding their property tax and insurance. And on the asset side, Linda and Larry have each an IRA worth $100,000. And they have a joint brokerage account of $75,000 and a checking and savings account worth $25,000. They also own a 3,500 square foot house in Miramar, Florida, valued at around $900,000. That's the one that has the mortgage. Under the original plan, they should be able to retire at the age of 67 if they are disciplined. To accomplish this, they'll need to contribute the $50,000 per year to their investment portfolio, okay? Which, for this exercise, will assume that they use the most efficient allocation between tax advantage, IRAs or individual 401ks, and taxable accounts. They are expecting market returns of around 9%, which we can see right here. And they'll do this exclusively by investing in the Vanguard's S&P 500 ETF, ticker symbol VOO, a low-cost index fund. In 2029, they'll be able to increase their contribution to their investments by $60,000 per year. Basically, they increase it from $50,000 to $110,000 because they would have paid off their mortgage by then. At that point in time, they'll own their own home and have no debt. This will give them the last boost needed to fatten up their retirement savings. Right here, see, look at the total going up. And by the time they get to their 67th birthday, they'll have, at the end of year 2037, they'll have $3.25 million. So this means that if they worked until age 67 or year 2037 and retire, their income in 2038 would be $48,000 from Social Security and about $114,000 distributions from their portfolio, assuming that they use a 3.5% withdrawal rate. Their annual retirement income would be $162,000 or close to it, which exceeds their $156,000 target, which is $100,000 in today's dollars, which assumes a 3% average inflation rate. So even though Linda and Larry only have $275,000 saved for retirement right now, if they follow their original plan, they will be able to, or should be able to, retire comfortably at age 67 if they follow the plan. However, now that with a new twist, what happens if they want to retire 5 years earlier at age 62 using the same assumptions, which are 1, average inflation rate of 3%, 2, a withdrawal rate of 3.5%, and 3, now they'll have to take a discount on their Social Security payment because they're retiring early. Social Security would discount 30% of what they would have received at age 67. This means that Social Security would pay 70% of what they had gotten in year 67. So it'd be 70% of $48,000. So let's review the scenario in Excel. Okay, now let's verify the scenario where they want to retire 5 years earlier with the same case. So they still contribute the $50,000 and they're using a 3.5% withdrawal rate. They finish paying off their mortgage in 2029, but they decide to retire here in year 2032. At that point, they will have about $1.7 million in their retirement fund, and Social Security would pay them, instead of $48,000, they would pay them $33,600. And based on that $1.7 million retirement fund, they would be able to withdraw about $59,000 from their retirement portfolio. So that gives them a $92,577 available, but their target was $134,392, which is equivalent to $100,000 in today's dollars. They don't make it. They're short by close to $42,000 if they cold turkey say we stop at age 52. So if they're retiring at age 62 without making any adjustments, doesn't work. If they're willing to adjust their retirement expenses and live with less, they could do so without making any change to the original plan. However, Linda and Larry don't want to adjust their expenses in their retirement time. They have plans to travel around the world, so we looked at other options. If they want to retire in 10 years at age 62 without reducing their retirement income, they would have to make some changes or some adjustments now. So there are infinite amount of options, but we came up with 2 options that are doable for Linda and Larry. Let's look at option A, downsize at retirement. That's what we're calling it. Let's go to option A and see what we did. There are 3 things that they need to do here. 1, they need to increase their contributions from $50,000 to $60,000 immediately. So that's what we did right here. Okay. And so that means that they're adding $60,000, and then when they finish paying off their loan, they're continuing to add $120,000 more. And they could come up with that $10,000 extra income per year by increasing or the amount of clients they serve in their accounting practice, or maybe rent out their guest room in Airbnb. The second thing that they have to do is they have to sell their home at retirement and buy one that's worth 40% of the original home. So that's this place. At 62, they decide to sell their home, which at that point in time will be worth close to $1.2 million right here, assuming that it went up with inflation. We did $900,000 originally at a 3% inflation. That's a $1.174 million home. They sell it and they buy a new home for $470,000. They downsize. And this is possible because their daughter has left the nest and they won't be using a home office anymore because they're retired. So they don't need that much space. So they can move to a smaller home. This will also reduce their expenses because the property taxes are less, utilities are less, and maintenance is less. And the third thing that they would need to do is to increase the rate of withdrawal from 3.5% to 4%. They'll have a little bit higher risk of running out of money, but it is still manageable. You can see in this video how to estimate your safe withdrawal rate. I did a video about it. By doing these 3 adjustments, they can retire at age 62 with $135,000. Here we go. With $135,000 in annual income, that is $333,600 from Social Security and close to $102,000 from their investment portfolios. Option B, downsizing early. In this option, there's no need to increase their contributions by $10,000 a year. This option involves 2 adjustments. 1, downsizing their home early. That is, selling their home that they are in right now on or before 2027 and buying a new one for half the value. That means that they are taking half of the value of the old home and putting it as an investment. We can see it right here in the yellow highlight in 2027. We basically sold a home for almost $1 million, a little bit over $1 million. They bought a new home for $506,000. By doing this early, they are converting their equity into productive investments. This will also reduce their expenses like property taxes, utilities, and maintenance. And number 2, they also need to increase their withdrawal rate, same as in option A. So they increased it from 3.5, if you recall, to 4. So under this option, they have a similar result. They end up with $136,758 in income available, and their target was $134,392 of income. That's equivalent to $100,000 in today's dollars. So what option would you take? Option A, which is selling their home and downsizing at retirement, or option B, which is selling your home early and downsizing early and making your assets more productive? I'll tell you what I would do. I would do option B, which is selling your home early and making your assets more productive. So let's see what Linda and Larry did. Linda and Larry decided to go with option A, selling their home and downsizing at retirement. Their reason is that since they work from their home office, they wanted to have the space. They said that they could easily add 3 to 4 new clients and increase their earnings by $10,000 to cover the savings that they needed in order to hit their goal. So there you have it. Both options were good options, but they decided to go with increasing earnings in order to get to their goal. What did we learn? We learned 3 things, or at least 3 things. 1, it's important to have a plan for retirement. If you don't have a plan, it is very hard to know if you're going to hit your target. Number 2, if you're in your 50s and don't know or don't think that you're ready because you don't have enough saved away, don't despair. There are always options. And number 3, make sure that your assets are as productive as possible. Make sure that they are productive assets.